Boyadjian from Compass Global Markets for more on this. Tony, great to see you there today, and thank you for joining us. Now, what were some of the most significant points that you pulled out from those Fed minutes overnight? Because there was really a lot to digest.
Yeah, there was a lot to digest, Leanne, but the most important thing was they indicated an appropriateness, if you like, to shrink the 4.5 trillion US dollar balance sheet. Now, they want to do that later this year, especially if the US economic growth continues on its merry way. Effectively, this is another form of tightening monetary policy without raising interest rates. So effectively, we saw the US dollar ease immediately after the Fed minutes came out, and also it started to weaken when US Speaker Ryan began talking about how they might need more time for tax reform. So the market is all of a sudden just put all the positive economic data to one side, and now we're concerned about the Fed speak again, because recent Fed speak tells us that they're expressing a cautious tone, and that's because they're expecting only a couple of more rate hikes this year before pausing. Now, it wasn't long before, it was early this year, they were talking about 4 rate hikes in 2017, followed by perhaps another 3 in 2018. Now we're talking about 2 and then pausing. So this is a concern because it looks like they're in no hurry, Leanne, to hike interest rates. It's going to be data dependent. That's what the Fed minutes suggested overnight. And all eyes will be on the US non-farm payrolls figures coming out on Friday night, because what we saw overnight was a very, very strong number in the private sector jobs. It was up 263,000 in March when the forecast was only 187,000. So if that translates to firm jobs numbers for the non-farm payrolls, then we could see the US dollar strengthen again. So it's in a merry-go-round sort of movement.
Up until now, Tony, we've been talking about the market, pricing in more rate hikes, maybe the fact that they've been sort of underestimating how quickly they could get moving. But the fact now that the Fed is talking about sort of tapering that balance sheet and maybe a slower pace, as you point to, how do you think the market might start to react to this?
Well, the market's going to try and buy some time now, because when they want to see what President Donald Trump's infrastructure spending pattern is going to look like, given the shrinking an expected shrinking of the balance sheet, and also to see what sort of timetable on the tax reforms we're talking about, because the longer this gets delayed, it means the chances of successive rate hikes become diminished, and that's going to put a lot of pressure on the US dollar going forward.
Mm-hmm. Let's also talk the US economic data that came out overnight, because we saw that ADP, the private payrolls read, which came through a lot stronger than expected. Clearly a sign, despite, an apparent slowdown in GDP growth in the first quarter, that labour market conditions still remain exceptionally strong.
They do, Leanne, indeed, and it's just not the labour market numbers either. When we look at fourth quarter economic growth figures, they were revised up by 2.1% per annum, and that's due to higher consumer spending. And if you look across the board there, US economic indicators are all very firm. We saw core personal consumption deflator figures come out recently, and that's the preferred measure of inflation for the Fed, and that was up by 0.2%, translating to a 1.8% per annum gain. And then we saw personal income figures rise by 0.4%, and notwithstanding that, the ISM manufacturing data printed with a 57 handle in front of it, which also suggests strong expansion in the US manufacturing sector. So the data in the US is quite strong. Where the weakness prevails is in what Speaker Ryan said overnight. We'll need more time for tax reforms, and if we're going to shrink the balance sheet going forward, then that could have a detrimental impact on their infrastructure spending as well.
Mm-hmm. Okay, let's move on, because I want to talk the Aussie dollar. It remains pressured, it seems, on the downside. The RBA, really continuing to favour tighter macro-prudential measures to rein in the booming housing market. That's certainly having an impact on the currency.
It certainly is, Leanne. The RBA's come out and reinforced its neutral monetary policy stance. They tend to prefer, as you mentioned, a tighter macro-prudential measure. It takes the heat off the Reserve Bank to comprehend interest rate rises in this current climate. What we've also seen is APRA reduced the proportion of interest-only loans in Australia now from 40% to 30% for total residential loans, and it's taking it's putting more heat now onto the housing market, but the RBA is sort of pushing that job now towards APRA and other bodies to consider rather than itself. And the fear that they have, and this is something that Governor Phil Lowe has spoken about in recent times, is that any future interest rate rises in Australia will have a larger impact on the Australian economy than it has in the past. And if we look at what's happening in the household consumption sector, I mean, household consumption is roughly about 70% of Australian economic growth as an indication. And if the debt servicing costs in Australia continue to rise, and that's the concern the RBA has, then it's going to affect household consumption levels. And that is the reason why we've seen APRA come out recently and further macroprudential sort of measures being taken. But you mentioned about the Aussie dollar. It's interesting there, just looking at the charts, Leanne, we've seen it just break the 200-day moving average. Around 75.40 was that 200-day moving average figure. A break below that level now instigates a move back towards 75 cents. 74.50 level is now firm support on the downside. We've already seen it come off 1.6, 1.7% over the course of the past week. And it was trading as high as 76.70 at one stage. And so the monetary divergence continues to favour the US dollar, given that the US economic figures have also been quite strong. But looking at the Australian dollar, we feel that some of the downside implications are also an afterthought of what happened with Cyclone Debbie and the flood situation there in Queensland and northern New South Wales, Leanne, because it's going to have a big impact on the Australian economy, and it will impact the Australian economy from a delayed coal and beef production angle. In fact, we expect around about 0.5% of global coal exports now may be lost because of the Cyclone Debbie and the after effects of the floods there. So that could have a detrimental impact on the Australian dollar. Look elsewhere, whilst the RBA is sidelined with interest rates, we expect no movements at all this year. In fact, probably not until late next year we will find movements in interest rates. If we look at what the market is currently pricing, there's only a 6% chance that we'll see an RBA rate cut by September this year, but there's a 49% chance that we'll have a rate hike over the next 12 months. And that is what the RBA is concerned about, and that's the reason why they're on hold at the moment.
All right, fantastic. Tony, we'll leave it there. Do appreciate you joining us. Thank you.
Great. Thanks, Leanne. Pleasure.
Tony Boyadjian there from